This is chasing wisdom. Real life, real money, real faith. I came up with a prayer and a plan. Kept my name on the line. This is chasing wisdom.
Real life,
Real money.
real faith.
I've been counting every step. Now I'm pressing through the noise. Hands up when the truth hit. I was built for this choice. This is chasing wisdom.
Real life,
Real money, real faith. Fade it out, then cut it clean. Chasing wisdom.
What up? My name is Rodney Lawson, and this is Chasing Wisdom Podcast. So today, we're going to talk about 8 ways to invest $1,000 in term profit. And if you stay to the end, I'm going to give you a bonus way to invest this $1,000. And it's new right now. It just started. It's something hot. You want to get in early before it's too late. All right. But without further ado, we're going to get right into it. So, let me just get this. All right. We're talking 8 ways to invest $1,000. All right. So, rental properties are not the only way to wealth. All right. So, let's talk about the landlord myth. This is what the real estate gurus not telling y'all. All right. The mainstream narrative around rental properties paints a picture of effortless passive income, but the reality involves vacancy losses, maintenance reserves, and 1 to 2% of property value annually, property management fees of 8 to 12%, and an emotional toll of tenant disputes. A $200,000 rental property might generate $1,800 per month in gross rent, but after mortgage, taxes, insurance, management, and repairs, the actual cash to cash return can drop to 3 to 5% less than many index funds. Before committing to landlording, every investor must calculate their true net yield, not just the headline rental income. The opportunity cost of lying up to the opportunity cost of tying up to $40,000 to $60,000 in a single liquid asset is enormous when the same capital diversified into other vehicles could generate comparable or superior returns with far less active involvement. Understanding these real numbers is the foundation of making smarter investment decisions. All right, y'all. So gross rental income is misleading. Always calculate your true net return after all expenses before evaluating any rental property. All right. So, opportunity cost, the investment killer no one talks about. Opportunity cost is the silent destroyer of wealth building potential. It represents what you give up by choosing one investment over another. When you lock $50,000 into a down payment on a rental property, you are simultaneously choosing not to invest that money in assets that might offer higher liquidity, diversification, and comparable returns over a 10-year period. $50,000 invested in a diversified equity portfolio earning 8% annually compounds over $107,000 without a single landlord call. Understanding the opportunity cost means evaluating every investment, not just one, on its own merits, but relative to the best alternative use of that same capital. This framework transforms how you think and how every financial decision and prevents the common mistakes of confusing familiarity with optimistic. So it's making it where you don't confuse what's familiar with the opportunity. You know what I'm saying? Always ask, compare what before committing to capital. The best investment is not just one that performs well in isolation, but one that outperforms your best alternative. You know what I'm saying? So don't be too optimistic. Make sure you checking and evaluating. All right. Now let's talk about liquidity, leverage, and $1,000 advantage. All right, one of the most overlooked advantages available to small investors is liquidity, the ability to enter and exit a position quickly without significant loss of value. Traditional rental properties are among the least liquid assets available, often taking 60 to 120 days to sell and incur 6 to 8% in transaction costs. By contrast, many modern investment vehicles allow you to start with as little as $1,000 and redeploy capital within hours if the market conditions change. This flexibility is not just convenient, it is a strategic advantage that allows investors to respond to opportunities and reduce exposure during downturns. Starting small also allows you to test multiple strategies simultaneously, learning through the real market experience before concentrating large sums in any single approach. So, liquidity is a strategic asset. The ability to move your money quickly in response to opportunities or emergencies is a genuine competitive advantage that small, flexible investments provide. Liquidity. You know what I'm saying? Now, I'm going to talk to y'all and I'm going to tell y'all about these 8 ways to invest $1,000. Small amount of money with high potential. You know what I'm saying? All right. So the first way is real estate without the landlord headaches, REITs, crowdfunding, you know what I'm saying, and more. All right. So REITs explain own real estate like a stock. A real estate investment trust or a REIT is a company that owns income producing real estate in shopping malls and office towers to apartment complexes and data centers, and is legally required to distribute at least 90% of its taxable income to shareholders as dividends. The structure makes REITs one of the most accessible ways for ordinary investors to participate in commercial real estate returns without direct ownership. Publicly traded REITs can be purchased through any standard brokerage account with as little as the price of one share, often under $50, and they offer daily liquidity. Unlike any physical property, sector selection matters enormously in REIT investments. Healthcare REITs, industrial REITs, and residential REITs different each behave differently across economic cycles. A beginner investor can start building a diversified real estate portfolio for under $500 by purchasing shares in 2 or 3 complementary REIT sectors. So REITs give you the real estate exposure, regular dividends, income, and daily liquidity, all the benefits of property ownership without a single tenant interaction. You know what I'm saying? So REITs is a good way to jump into the real estate game, you know what I'm saying, without having to have the tenant headache. All right. So now what's another way? Real estate crowdfunding. Investing in deals like an insider. All right. Real estate crowdfunding platforms allow individual investors to pool capital with others to fund specific real estate projects, from residential flips to commercial developments that were previously accessible only to wealthy accredited investors or industrial players. Platforms like Fundrise, Reality Mogul, and Arrive Homes have democratized access to these opportunities with minimum investments as low as 10 to $500 depending on the platform and deal type. Investors typically earn returns through a combination of quarterly dividend distributions from rental income and appreciation based payouts when the property is sold, with historical average returns on many platforms ranging from 7% to 12% annually. The key distinction between crowdfunding platforms is their redemption policies. Some offer limited quarterly redemption windows, while others lock capital for 3 to 7 years. So, understand your liquidity needs before investing is essential. Diversifying across 2 or 3 crowdfunding platforms and multiple project types reduce concentration risk and significantly. Real estate crowdfunding gives you institutional level deal access at beginner price points, but always understand the lockup period before investing a single dollar. So that's a good way, but you must pay attention to the lockup period because they will lock the money up for 3 to 7 years, whatever you're putting in. All right. Now, this is another way. This is what a lot of the gurus try to tell y'all right now. Tax lien certificates, the contrarian real estate play. All right. Tax lien certificates are one of the most underutilized and misunderstood investment vehicles in real estate, offering government guaranteed fixed returns that can range from 8% to 36% annually, depending on the state. When property owners fail to pay their property taxes, local governments place a tax lien on the property and then auction off the right to collect that debt, plus interest, to investors. The investors pay the overdue taxes, receives a certificate, and either collects the redemption amount with interest when the owner repays the debt, or in a minority of cases, initiates a foreclosure process to acquire the property itself. The key advantage is that the returns are set by the statute, not by market forces, making this one of the few investments with truly predictable fixed rate returns. Beginners should start by attending online county auctions in states like Florida, Arizona, and Iowa, which have well regulated and investor friendly tax lien processes, and by limiting early purchases to certificates under $1,000 to build experience. All right, so when you start off, you want to start off with under $1,000. All right, tax lien certificates offer government mandated fixed returns of 8 to 36% annually. One of the few investments where your return rate is literally set by the law. So when you do the tax liens, you put your money in. If they pay their taxes back, you get that money plus interest. So it's set in stone. If they don't, you have an opportunity to foreclose the house and take over the property. All right. Mortgage notes, becoming the bank instead of the borrower. Investing in mortgage notes means purchasing the debt obligation secured by the real estate, essentially stepping into the role of the lender and collecting monthly principal and interest payments from borrowers. Notes can be purchased at face value from originators or at a discount on the secondary market, where performing notes, loans with current paying borrowers, and non-performing notes, loans in default, each offer distinct risk reward profiles. A performing note purchased at 10% discount with a 7% stated interest rate effectively yields over 8% to the note investor without any property management responsibilities whatsoever. Non-performing notes, while riskier, can be acquired at discounts of 40 to 60% and resolved through loan modification, deed and lien agreements, or foreclosure to generate substantial returns. Beginner investors should start with performing notes under $5,000 through note brokers or platforms like PaperStat to understand the mechanics before venturing into distressed debt. All right. So buying mortgage notes mean becoming the bank. You collect monthly payments secured by real estate without owing the management in property. So you don't have to own or manage the property. You just buy the note and collect the payments. It is risky, but start under $5,000 and you should be good. You gotta learn the mechanics though. All right. Now, so those were the real estate ways. Now we finna talk about high return strategies with $1,000 or less beyond real estate. All right. So index funds and ETFs, born beautiful and brutally effective. Yes, sir. Index funds and exchange traded funds have consistently outperformed the majority of actively managed funds over 15-year periods, with S&P 500 index funds beating over 88% of the large cap active fund managements, according to the SPIVA research. The genius of index investing is the compounding effect of combining with minimal fees. The average expense ratio for an index ETF is 0.03% to 0.20% compared to a 0.5% to 1.5% for active managed funds. And that fee difference compounds dramatically over decades. A $1,000 investment in a broad market index fund earning 8% annually grows to approximately $10,000 in 30 years without a single stock pick, market timing decision, or tenant phone call. Total market funds like VTI or FSKXA KAX give immediate exposure to thousands of companies with one purchase, eliminating individual stock risk while capturing the full return of the economy growth. Dollar cost averaging, investing in fixed amount at a regular interval regardless of the market condition, is most reliable method for building long-term wealth through index investing. So index funds are the single most proven wealth building vehicle for ordinary investors. Low cost, broadly diversified, and historically superior to most professional fund managers. All right, index funds. All right, let's talk about dividend growth investing, building your own paycheck. Dividend growth investing focuses on acquiring shares in companies with a long, consistent history of not only paying dividends but increasing them annually, a category known as dividend aristocrats that have raised their dividends for at least 25 consecutive years. The compounding power of reinvesting growing dividends creates an accelerating income stream that can eventually surpass the investor's original investment in annual payouts. A company that pays a 3% dividend yield and grows that dividend at 7% per year will double its payout in roughly 10 years, meaning an investor who started receiving $30 annually on a $1,000 investment will eventually receive $60, then $120, all without adding new capital. The strategy requires patience and focus on quality, prioritizing companies with strong free cash flow, manageable payout ratios below 60%, and business models with durable competitive advantages. Beginners can start a dividend portfolio for under $200 using fractional shares available on platforms like Fidelity, Schwab, and Robinhood. So focus on dividend growth, not just dividend yield. A company consistently raising its payout creates a self-compounding income stream that accelerates over time without additional investment. You know what I'm saying? So dividend stocks. That's what a lot of people say, and they like to try to add it with the Roth IRA or the IRA accounts and get it tax free. And by the time it grows, you just get the money, and it's building on top of building. All right, peer to peer lending and private credit, earning the bank spread. All right, Private credit investing allows individual investors to act as lenders to individuals or businesses, earn interest income that typically exceeds what the available through traditional fixed income investments like bonds or CDs. Platforms facilitating this include Prosper Lending Club, now called Institutional Focus, and Kiva for the international microloans will return on consumers' loans historically ranging from 5% to 10% for well underwritten, diversified portfolios of loans. The critical risk management principle in this asset class is granularly granularity, right? Spreading capital across a minimum of 40 to 50 loans so that any single default has minimum impact overall portfolio performance. Unlike bank deposits, these investments are not FDIC insured and carry meaningful default risk, particularly in economic downturns when consumer credit quality deteriorates. Investors should focus on higher credit grade borrowers initially, diversify across loan grades, and reinvest interest payments to harness compound growth. In peer to peer lending, diversification is everything. Spread your capital across as many loans as possible so individual defaults become statistical noise, not financial disaster. So if you do the peer to peer lending, make sure you just spread the money out, not just focusing on one, person, one loan, because it can cause a financial disaster if your money not spread out. You don't want to put it all in one bucket and it default. All right. Now, micro business and digital asset investing, the $1,000 entrepreneurial play. The digital economy has created an entirely new category of investable assets, income producing digital properties, including content websites, niche blogs, YouTube channels, newsletter businesses, and e commerce stores that can be acquired, improved, and either held for ongoing cash flow or sold at a multiple of annual earnings. Marketplaces like Flipper, Motion Invest, and Empire Flippers list digital assets business for sale with small content sites often priced at 30 to 40 times their monthly net profit. Meaning a site earning $50 per month might be acquired for $1,500 to $2,000. An investor who acquires a small content site applies basic SEO improvements and increase its monthly earnings from $50 to $100 has effectively doubled their investment value. The key skills required are basic content evaluation, traffic analysis using free tools like Google Search Console and Ahrefs free tier, and understanding the monetization models including display advertising, affiliate marketing, and digital product sales. This category represents the frontier of small capital investing with outsized return potential. For those willing to develop relevant skills into these assets. All right. So digital assets like content websites or income producing businesses you can buy, improve, and sell, creating both ongoing cash flow and capital appreciation with fair lower entry costs than physical real estate. You know. All right. So now we're gonna build our professional portfolio, personalized with $1,000 investment blueprint. So, know your investor profile, risk, time, horizon, and income goals. Before allocating a single dollar, every investor must honestly assess three critical variables: the risk tolerance, how much loss can they emotionally and financially absorb without panic selling; their time horizon, how long before they need to access the invested capital; and their primary objective, capital growth versus current income versus capital preservation. These three inputs determine the optimal mix of assets more reliably than any market prediction or guru recommendation. All right. An investor with a 20-year horizon who won't need the funds for decades can weather significant volatility and should weigh their portfolio towards equity heavy growth vehicles. An investor who needs supplemental income within 2 to 3 years should prioritize high yield, lower risk income assets like dividend stocks and note investing. Creating a written investor policy statement, even a one-page document, dramatically reduces the risk of emotional panic driven decisions during market downturns. So, your risk tolerance, your horizon, and income goals are the three inputs that determine your optimal investment mix. Get these wrong, and even a great investment will fail. You know what I'm saying? Because you'll panic, move the money out, pull it out early, anything. So you got to already know how long you going to put the money in here. How fast do you need this money back? You know, and how much you're willing to risk. You know what I'm saying? All right. The $1,000 allocation framework, building your first portfolio. A balanced $1,000 starter portfolio can be structured across four categories to optimize for both growth and income while managing risk through diversification. A practical allocation for a moderate risk investor with a 5 to 10 year horizon might include $400 in broad market index funds or ETFs for core growth, $250 in a REIT or real estate crowdfunding platform for income for inflation hedge, and $200 in dividend growth stocks purchased through fractional shares, and $150 in a higher yield alternative like a tax lien certificate, note investment, or P2P lending position. The structure ensures that no single vehicle represents more than 40% of the portfolio, providing meaningful diversification while keeping the strategy simple enough to manage without professional oversight. As returns accumulate, reinvest all the dividends and interest payments into the same allocation pattern. Compounds growth without requiring additional external capital. The goal in the goal in year one is not to get rich, but to learn how each vehicle behaves, which one resonates with your temperament, and which you want to scale. You know what I'm saying? So a balanced $1,000 portfolio across four vehicles: index funds, REITs, dividend stocks, and one alternatives gives you growth, income, inflation protection, and real world education all at once. You know what I'm saying? All right. Scaling from $1,000 to $10,000. The reinvestment compounding strategy. All right. The journey from $1,000 to $10,000 is achieved not primarily through spectacular investments, but through disciplined, systematic contributions combined with full reinvestment of all invested income. An investor who contributes $200 per month to their portfolio and reinvests all dividends and interest will cross the $10,000 mark in under 4 years, even at a conservative 6% average returns. A milestone that qualifies them for most brokerage investment minimums and opens access to additional investment tiers. The reinvestment rate is as important as the return rate. An investor earning 8% returns who receives 100% of income dramatically outperforms an investor earning 10% who withdraws income, particularly over 5 to 10 year periods. Automating contributions through recurring transfers eliminates the emotional friction of deciding to invest each month. Converting wealth building from a decision into a habit. At $5,000 milestone, the investor should review their allocation consolidation underperformance and consider adding one new vehicle depending on diversification. All right. So consistency and reinvestment are more powerful than return rate. Automate your contributions, reinvest all income, and let compounding do the heavy lifting on the journey to $10,000 and beyond. You know what I'm saying? All right. Now, this is a tax strategy for alternative investors. This is how you keep more of your money in your pocket. The tax efficiency is most underestimated component in investment returns. A strategy that generates 10% pre-tax returns but is held in a high tax environment may underperform a 7% tax advantage strategy on a net basis. Tax advantage accounts include Roth IRAs, traditional IRAs, and solo 401ks should be the first destination for investable capital because they shelter gains from annual taxation and allow compounding to work on the full pre-tax amount. REITs, dividend stocks, and P2P loan interests are particularly well suited for tax advantage accounts because their income would otherwise be taxed as ordinary income. Long-term capital gains tax rates of 0%, 15%, or 20% apply to assets held for over 12 months, making a hold longer strategy not just emotionally disciplined but mathematically superior to frequent trading. Consult with a CPA or a tax professional familiar with the alternative investments, particularly for tax lien certificates and mortgage notes, which have specific reporting requirements, is a wise investment of $200 to $300 that can save thousands annually. All right, so the tax strategy is important as investment selection. Place your highest income assets in tax advantage accounts first to ensure compounding works on the full pre-tax amount, not after tax remainder. You know what I'm saying? So you want to protect your money from being taxed. You got to put them in, like I was telling y'all earlier, the IRAs and the 401ks. All right. Now, I told y'all I was going to give y'all a bonus at the end. So without further ado, I'm going to tell y'all about a new venture that just came out, and they're literally looking for investors to invest just $1,000. That's the minimum, with a share value of $50, you know what I'm saying, into their real estate venture. And the company is called Golden Trinity. If you want to join and invest, they're gonna take the money, they're gonna take all the money and start building uh real estate. They're gonna have all kind of properties, apartments, um vacation rentals, apartments, uh, all kind of real estate. You know what I'm saying? Commercial and residential. So they're gonna take all the money that everybody's investing, give you a share, and you will be making you will be receiving benefits. You'll be able to visit any property and stay for free. Uh and you'll get a return on your investment over time. Um, so they want a minimum of $1,000 to join, and they just gonna take the money and put it into the business and get the profit. They basically trying to give people the opportunity to get into real estate without having high investment. All right. So the site is called Invest. Golden Trinity Group. You know what I'm saying? Invest. Golden Trinity Group is the website. So you'll increase your need for diverse rental and commercial properties. High demand for long-term rental units. The demand for long-term rental units, especially multi-unit properties with 20 plus units, is on the rise as urbanization continues to home and homeownership becomes less attainable for many. The need for reliable and affordable long-term rentals is increasing, according to the Joint Center for Housing Studies of Harvard. All right, so they saying the demand is growing. The demand is growing for multi-unit properties as house properties become hard to obtain. You know what I'm saying? So this is the problem they're telling you. It's a shortage of long-term rental units. It's inadequate. It's an inadequate supply of safe, secure, reliable short-term rental options, and it's insufficiency availability of commercial real estate. All right, so they're gonna build new construction. They got property acquisition. They got available properties, long-term rentals, rental solutions, short-term rentals, commercial properties. You know what I'm saying? This is the opportunity. So leveraging crowdfunding to create an opportunity accessible to diverse groups of investors. Golden Trinity is raising capital through through Reg CF to democratize real estate investment and address the critical issues in the real estate market. This fund is designed to provide an accessible entry point for investors of all levels, allowing individuals to participate in real estate opportunities that were previously out of reach for many. By lowering the barrier to entry, Golden Trinity enables a broad audience to benefit from the potential returns of real estate investments. All right. Our fund support, not our funds, but their fund. I'm reading off their site. All right. Our fund supports a diversified portfolio focusing on acquisition, development, and management of various property types, including multi-unit residential buildings, short-term rentals, and commercial properties. The balanced approach ensures that our investments are not only financially valuable but also socially responsible, catering to the diverse needs of the market. All right, investors in Golden Trinity Reg CF Fund can expect access to high quality real estate projects. So we meticulously evaluate and select projects that offer strong potential for returns and growth, ensuring our investors are part of a high value opportunity. All right, diverse investment portfolio. Our fund includes a mix of property types from long term, short term rentals to commercial properties, providing stability and reducing risk through diversification. All right, professional management oversight. Golden Trinity experienced team oversees all aspects of property acquisition, development, and management, ensuring that each project meets our high standard of quality and profitability. All right. Transparent reporting and communication. Investors receive regular updates and detailed reports on performance of their investments, providing transparency and peace of mind. All right. Now, this is about the money. This is the important part. Earnings and distributions. Golden Trinity LLC is committed to providing investors with consistent and transparent profit sharing opportunities. All right, profit allocation. Profits will be distributed on a pro rata basis to all investors in Golden Trinity. Into Golden Trinity, quarterly payouts. Investors receive profit distributions every 3 months, ensuring a steady stream of potential earnings. And property sale dividends. When Golden Trinity LLC sells a property, any realized profits is distributed among shareholders. All right. Investor benefits. Rental income opportunity. Investors contributing $1,000 or more can have Golden Trinity rent their primary residence or individual rooms, earning 50% of the proceeds from the bookings. All right. Exclusive event access. Investors contributing $1,000 or more will receive invitations to celebrity events hosted in 2025, offering unique networking and entertainment experiences. By participating in Golden Trinity Reg CF, investors not only gain the potential for financial returns, but also contribute to solving pressing housing and commercial real estate challenges. This unique investment opportunity aligns fractional success with social impact, making it an attractive option for those looking to make a difference while growing their wealth. All right. So this is the opportunity to get into the real estate game. You're gonna get payouts. You're gonna get profit allocation, and you're gonna get property sale dividends if a property sells. So this is big if you want to jump into real estate and you don't have much funds for real estate. This is a great opportunity for you. Um, Again, that site is invest.goldentrinitygroup.com. I just wanted to throw that out there. I came across their video the other day and I was like, that's a good idea there. You know, if you can put more than $1,000, you can, you know what I'm saying, accumulate some monthly income and also, you know what I'm saying, get dividends, getting property acquisition, you getting a portfolio, you getting a lot of benefit here, you know, and if a property sells, you getting money there too. But yeah, that's that bonus I wanted to throw in there for y'all. Again, my name is Rodney Lordsman, and this is Chasing Wisdom Podcast. I'm gonna see y'all on the next one. Peace.
Yeah. This is Chasing Wisdom. Real life, real money, real faith. I came up with a prayer and a plan. Kept my name on the line. This is Chasing Wisdom.
Real life,
Real money.
real faith.
I've been counting every step. Now I'm pressing through the noise. Hands up when the truth hit. I was built for this choice. This is Chasing Wisdom.
Real life,
Real money, real faith. Fade it out, then cut it clean. Chasing Wisdom.